Good evening and welcome everybody. My name is Doc Severson. I will be your host and instructor tonight as we talk about increasing your probability of profit with vertical option spreads. So away we go and welcome aboard. Now before we get started tonight, here is our standard risk disclosure, which essentially says that if you don't treat this like a business, my friends, this will be the most expensive hobby that you'll possibly undertake. I will be not recommending anything tonight for buying nor selling. This is for investment education only. So again, copyright disclaimer, please do not distribute this without our permission. We are quite willing to talk to you. Give us a phone call there or send us an email if you'd like to redistribute this. Now about TheoTrade, we are a trading education firm based out of Scottsdale, Arizona, specializing in education for options, futures, and stocks. We've been started by veteran professional traders who are first and foremost experienced trading educators. We're not a registered advisory service or brokerage firm. So although we provide the best trading education in the business, your results and ultimate responsibility are your own. We do everything that we can to put you in a position of success, but individual trading results will vary. Trading has risk. It involves real money. We're here to help you mitigate the risk in the market while learning a skill that can last you for life. Now, some of you may know me, some of you may not know me. Again, my name is Doc Severson. I am a husband, a father of 3 great kids. I'm a student pilot waiting for the ice to melt off the wings of the planes out here. I am a reformed engineer. Yeah, I used to be one of those guys that was just into engineering, and I decided that that was no longer in my future. So I quit my 6-figure telecom job to trade full-time, and I've not looked back over the last 13 years. So for TheoTrade, I've been with TheoTrade for almost 2 years now, and I am an options technical analysis and NLP, which is neuro-linguistic programming, if you didn't know what that is. And those are what I specialize in with TheoTrade. So I've been trading for 21 years myself, and I like to think of myself as an innovator. I like to bring ideas in a different manner to people and let them know how much they really already know, because so many things that I see about trading relate to nature and humanity, which is something most of us already know about. So I've been trading with thinkorswim for 12 years. We're not going to be really using that much of thinkorswim tonight, but certainly that's what we typically use in the room. And a couple years ago, I wrote a book called Hacking the Holy Grail, and it's currently on Amazon. The point of that book is that everybody's out there trying to find the Holy Grail, and actually, if you wouldn't know it, it's right between your ears. So that's how you hack the Holy Grail. Our objectives for tonight's presentation is I want to talk to you about why we've lost edge in today's market, why so many of you out there feel frustrated trading today's market, and you're not alone. So we got some reasons why and what we can do about it. I also want to talk to you about chart analysis and what I'm seeing a lot of people do, and I can't help it. I got to tell you what not to do. I'm going to make some recommendations about what not to do that I see a lot of people doing. So we will talk about how we should analyze charts differently in today's market. This is a different market. This is a different beast. In some ways, it really is different this time. We will talk about 4 fractal rules to use. If you don't know what fractals are, it's okay. We'll get to that point. And then I'll talk about next steps, of course. So I want to take you down a little journey and make you realize how much you already know, what you've already been seeing in the markets, and realize that you actually just need to unlock those skills that you already have right now. Now, a little bit of housekeeping before I dive into this tonight. Yes, you will get a recording of tonight's session. Yes, you will. I typically move very quickly through the material. I tend not to bloviate for too long. I want to respect your time tonight. You guys are taking your time away from Jeopardy and your families and everything else that you're working on. I want to respect your time, so we'll get you in here and out of here as soon as we can. Okay, so please do me a favor, hold your questions until the end of the session. I found out this the hard way a couple of years ago. I was doing one of these, and I like to help people. I like to answer questions. Trust me. That's why I do this, is because I love helping people. And I would stop to answer everybody's question, and it just got everybody else chapped. They're like, get on with it. So I am not going to look at the chat window until we get to the end of today's session, and then I'll be happy to help you and take your questions. Okay, so we have staff online. If you have admin questions, can't get something working, have some questions about how to move forward from here, we are here to help. So we have Jeff, we have Don, we have JP. Everybody is out there ready to help you. Onward, part one, where did all the edge go? Where did all the edge go? So that's what we're going to be talking about first. So a lot of the problem is due to all of this, what I'll call fiat currency that we have floating around the system for the past few years of central bank activities to bolster their economies. I will never forget, it was August, late August in 2010 when Ben Bernanke stepped up to the microphone in Jackson Hole, Wyoming, and said for the first time that I can recall that, yeah, we're actually going to be printing money. Before that, it was sort of a joke. It was sort of like this big rumor. Hey, what about the plunge protection team? Those kind of things, right? So we never really knew, and they stopped reporting M1 and M2. And it's like, what happened to all these numbers? Are they printing money? Well, finally, he admitted it. Yeah, we're going to be printing money, and a lot of it. Even now, they're still doing it, even though they've talked about the taper, right? So this has caused an excess of liquidity and forced yield out of just about everything but stocks. They tried to get this whole wealth effect going, and unfortunately, most people didn't know how to take advantage of it. And we still have negative rates in some countries. Would you rather be charged a fee to keep your money in the bank, or would you rather put it into something generating positive yield and maybe even dividends? This is why every little tiny microscopic dip is being bought these days. So the end result is that investors have no fear today. They know that every dip is going to be bought because the low rates and no fear, there's an incessant search for yield across all asset classes. Alpha is difficult to find across the board. It's nearly impossible to find. So because of all these factors, volatility, and I'm just talking about price volatility right now, it's near all-time lows. Look at this. This is ATR. This is average true range. It's crawling along the floor down there. There's just no range. There's no fear in this market. So this is not only the realized volatility of the price movements as measured here, but it's also the implied volatility of the options pricing going forward is also crawling along in the gutter. This has created some unusual and challenging conditions for today's options trader. I mean, it was just not that long ago we had actual VIX in the 20s, and now we're stumbling along, threatening to go into single digits again. So even though the trend of the market is quite defined to the upside, the short-term entry points are hard to find and are leading traders in the dust as the trend takes off in these parabolic runs. Everybody's waiting for the dip, and the dip never shows up, and it takes off. And there's one thing that I say all the time is that the pain of missing out on an upside run like this is actually far greater. They've measured this. Psychologists have measured that it's actually far greater, the pain of sitting in the sidelines, than actually taking a stop loss. Imagine that. So this is why we're getting into these FOMO, or fear of missing out moves. So unless you know what you're looking for, there's no way to get on board. This is what I'm going to be talking about tonight, is how to get on board these things. The dip buyers aren't getting the dips that they're waiting for. They're being forced to chase after that. We all know that that's a bad thing to do. Let's not do that anymore. So what about if you're selling credit spreads, right? They keep wondering when they're going to get run over on the next upside ramp. It's absolutely been a nightmare to be a call spread seller, especially in the last few months. A nightmare. But you're also concerned about the next waterfall decline. If you're selling vertical put credit spreads, you're wondering when the next waterfall is going to show up and run you through, right? You're waking up at 2 o'clock in the morning to make sure the futures aren't dipping. That's no fun. So it's massive risk when you have no implied volatility available to give your position distance. So something I learned a long time ago from working on cars is that there's no replacement for displacement when it comes to credit spreads. You want distance and displacement. So many traders are just choosing to stand on the sidelines and watch this mammoth thing go by, convinced that it's going to crumble any day while it continues to go higher and higher and higher. They don't know what to do. So this is what we're going to focus on today, is solutions for handling this market. Part of the problem here is that we have inaccuracy and subjectivity as far as looking at markets. So many times I see traders that are just chasing these trades open themselves up to risks that they could have avoided had they had a different skill set. Maybe just a slightly different way of looking at things could have made all the difference in their results. So something like this, where you're selling a credit spread, right? So you're selling a credit spread, and this has got to be the top. Look at this thing. It's taken off here. So I'm going to sell a call credit spread up here. It's a bearish trade, and that should be good to go because this thing is overbought, and there's no way that it's going to go down from here. So you know the answer to this, right? Your face has just been surgically removed. You thought this was the high, and it was just getting started from there. That was silver, by the way, back in 2010, 2011. So what is overbought can remain so for a long, long period of time. And this is one of the problems with today's analysis, is that I still hear people referring to this phrase of, well, it's overbought. It's got to turn down. It's still overbought. It's got to turn down. Guys, what remains overbought can do so indefinitely for as long as it wants to. We don't have an edge determining when something is overbought anymore. I'd like to banish it from your vocabulary, if I may, tonight. And this is kind of like today's S&P 500. What is overbought can remain so nearly indefinitely, to the consternation of many. Okay, so back to our SLV trade. You just took a full loss on your short call spread. Ouch. So what you do is you say, well, okay, I'm going to play a little bit of revenge trading. If this thing is going to rally like that, I'm going to flip around and play a bullish call debit spread or an in-out spread. And so we're going to buy a spread up there. The price is in a bullish trend, so let's just get long. Let's play random walk. We don't know where this is going, but obviously it's going higher. And then unfortunately, oops, the chart hates me. That's your conclusion. This price hates me, right? This is the subjectivity that I see all day long. Far too many of us are using arbitrary trade entries based on when we feel bullish, based on when we feel bearish, or maybe we're using outdated tools such as looking for things to be overbought, oversold. I will grant you that a short oversold signal in today's market is quite good. But stay away from the overbought stuff, guys. We're generally trading with the herd if we're using these types of tools. We're about to get run over, or we're about to fall through the trap door. So how do we add more precision to our trade setups? That's what we're going to be talking about tonight. Before I do that, though, we have to kind of clear away the clutter. We have to talk about what not to do. Again, I've been teaching the markets ever since I went solo, and it wasn't really my intention to do something like that. It was almost a gunpoint. I had people showing up at my door refusing to leave until I would teach them, and eventually I found out that I enjoyed it. So I have seen just about everything over the past 13 years in terms of what people do. But, you know, a lot of things are really kind of the same thing, though. I see the same types of analysis. I see the same types of linear logic and conclusions that people come to. And invariably, they're wrong. Let me give you an example of that. So we can't trade the market that we want. Can't, right? You know, you can go back and say, man, I remember that market in 2008. Boy, that was exciting. And it sure was. It sure was exciting. But I still see people that are pining for those days from 10 years ago. We can't trade the market that we want. We can only trade the market that we have in front of us. So many traders fight back by applying more analysis, right? So they can't get something working, and so they think, hey, I saw this really cool tool the other day, and I think if I just add one more study to my charts, I'll be all set. Let us see if you recognize this. They try to create more certainty by adding trailing indicators, and usually lots of them. More is better, right? The more indicators, the better. So we could start out with something like this by looking at the price, and we say, well, that's just the price. That's not enough, just these red and white candles. I need more. Sounds like a Geico commercial, right? So we add the full stochastics on there, and that's not enough, just overbought and oversold. I need more. Oh, I saw this really cool ad the other day for the Arun oscillator, so I'll add the Arun oscillator on here. This seems to be fantastic. And that's not enough, so we need to add ATR, and we need to add the market forecast. We need to add the Keltner channels, and we need to add regression channels, and we need to add the RSI, of course. And pretty soon we've got nothing that we can read on this chart, and we've obscured everything that we really want to see, which is the price, which is hidden within the Keltner channels up there in the blue envelope. So we think that adding one more indicator is going to give us the missing edge, and unfortunately it usually works the opposite way. We get analysis paralysis. Through all these trailing entries, we end up with late entries. We wonder why we have no edge into this. So we need a different approach to analyze and determine spread trade entries in today's market. We need to simplify and get down to the root of the issue, the crux of the biscuit, as they say. And a method that's going to work when volatility returns again. That's another thing. So how many of you guys are sick and tired of learning about something that worked a few years ago and then all of a sudden it doesn't work in this market anymore? You got to have something that's durable, something that's based on how markets move. And that's something that stops working when it feels like it. And that happens all the time with markets. They change their stripes right when everybody gets in tune with it. So now we're going to get to part 3 here. Chart analysis in today's market, So I want you to stop thinking about market analysis in yesterday's terms, using tools that worked with yesterday's market. Just because you got a book on a shelf from John Murphy about technical analysis that was written back in 1985 doesn't mean that all of it still applies towards today. Now, the price action, if there's anything in price action, it certainly does. But markets move differently for reasons that we just went over a few minutes ago. So we need to start using market analysis tools that better reflect the movement and edge that markets are showing today. Now, what I find is that markets in range contraction, and let me illustrate this, markets in range contraction. It's time to bring out the pen again. So markets in range contraction are doing this. They're contracting in the range. And many times they'll even start to work into recognizable patterns that you may have seen before, such as this small little pennant pattern, or we can look for little horizontal box patterns, or we can look for flags and whatever you want to look for here. But each of these is an example of markets in range contraction. Range contraction where it's basically going nowhere. But markets in range contraction do an odd thing. What they do is they build up potential energy. A market that's going nowhere, and meanwhile everybody is not looking at this thing, by the way. Nobody cares about this because it's not moving. You don't see this on anybody's sizzle list for the day, because it's in consolidation. But what it's actually doing, it's just like winding up a big spring like this, winding it up tighter and tighter and tighter until finally it can't contain that energy anymore and it springs out of there. It's the same thing that happens. It's like you put a small child into a pen, let them sit in there for a while, and it's not going to last very long. It's not going to end well. They're going to be out of there before you know it. right? Range contraction leads to range expansion. Range contraction leads to range expansion. Range contraction leads to range expansion. On and on and on and on. Ad infinitum. This is how markets work. Think about this. If you were going to run up the side of a mountain, so you want to run up the side of a mountain, are you going to be able to do that? I certainly can't do that anymore. I'd be able to go a certain ways, and then I'm going to have to rest. Maybe sit down, grab some water, restore myself, and then maybe I'll go the next leg, and then I'm going to have to do the same thing. But human beings even work in the same manner. Range expansion, range contraction. This is how things move. This is how markets move. So let me clean up my mess here. And so markets and range contraction leads to range expansion. Leads to range expansion. So I want you to start looking at markets in a little bit different way. I don't want you to look at them from overbought, oversold anymore. I want you to look at them from the perspective of range contraction leads to range expansion. And actually, one more level of depth to this is that range expansion leads to exhaustion, which leads to range contraction again, right? We don't rest because we just want to. We rest because we have to. And this is what happens to markets as well, too. They rest because they have to. And then they go back to range contraction again. So larger time frames also produce larger signals. So the previous charts were on the daily chart, right? These are on the daily chart. We can also look at the weekly chart. And the weekly chart will have larger signals that consolidate for longer periods of time and build up greater reserves of energy before they blast off. So this is why I will look at this, and we'll look at this later on. But I mean, when I have a signal that's showing up with 3 major time frames are in contraction, and trust me, nobody's watching this stock. If you've got the monthly and the weekly and the daily stock in consolidation, everybody has gone to sleep on that issue. Nobody's watching it at all. And all of a sudden, these things come out of hibernation, just like a bear, and they start to charge. And it's awesome to watch. So larger time frames also produce larger signals. So let's see how to apply this by framing this method in 4 simple rules. Now, hopefully you guys got the chart download. That should have been one of your gifts for attending, your little thank you for attending tonight's presentation. So I'll show you how I use this. And that leads us into part 4. We're trucking right along. We're making good time. I'll have you guys out of here soon. What method works in today's market? 4 simple rules. 4 rules, 3 charts. And this is for swing trading, but I also use the same type of methodology for intraday trading. So whether it's kind of a longer term intraday trade, maybe it's something I'm going to hold on for a couple of hours, or maybe it's even a very short term scalp trade that I'm taking with futures. It's the same strategy. We use different time frames. We're just narrowing down what we use. I don't have to have different strategies and different methodologies for different types of trading. Everything works off the same principle. So the chart is split up into multiples of 5. So if you look at this, the factor of 5, so if we have a monthly chart over here, so here's our monthly chart, here's our weekly chart. Work with me here. There's approximately 4 to 5 weeks within a month. Okay, so it's not perfect. It's not a perfect factor of 5. But if we look at the weekly chart going down to the daily chart, yes, when it comes to equity trading, there are 5 days in a week. Right? So we have this kind of factor of 5 between these. We have a child chart down here, and we have a big old anchor chart up here, and we have a kind of a secondary anchor chart. So they work together kind of as a family. So this family with a factor of 5 in them. Okay, so you might have even been using these time frames before, but I will do things like intraday. I will use, like if we have a 2-minute chart over here, we maybe have a 50-minute chart. Or excuse me, I'm sorry. We have a 10-minute chart here, and we'll have a 50-minute chart here. And so we'll use these 3 time frames like that. Or even tick charts. So I'll use like a 133 tick chart here, and I forget the exact number, like 665 in the middle, and then maybe 3325. So whatever the 25 times of that is. So this factor of 5, we split the charts up into multiples of 5. The lower study represents the energy available. So let me talk about that for just a second here. This is based off of what we call the fractal energy study. And the simplest way to think of this is not overbought, oversold. I don't want to hear that. We're not going to talk about overbought and oversold in here. Those are verboten terms in this webinar here. What this means is that this is a ton of energy sitting there. There's a lot of energy built up. That's a lot of consolidation right there. What we have down here is no energy left. So this is a runaway market, and we're going to have a consolidation from here fairly soon. Okay. Low energy and low energy. This is actually the first time I've seen this strong of a signal in a long time. This is a very unusual signal that we have with nearly a vertical mode. This is totally a runaway market that we're in right now. Okay, but this represents the energy available. So when we have high levels of energy down here like this is when we can start to anticipate some movement. From range contraction comes range expansion. Range contraction to range expansion. Okay, so we're reading the different time frames up here. We're going to be looking at price action, and we're going to be looking at energy down here. This is high energy up at the top, and this is low energy down here. High, low energy. Think of it as a fuel tank. A lot of fuel in the tank. This thing's getting ready to move. Low fuel in the tank. This is probably going to stop and consolidate from this point. High energy, low energy. Okay, got it? All right, let's move on and start to apply this with some trades. So now we have 2 price action rules and 2 energy rules. So we're going to get into these. The price action rules are larger time frames establish and dominate the trend. The best analogy that I can give to you for this rule is imagine that you're walking your dog. Imagine that here's you're walking in this direction down the sidewalk. So you're walking in this direction down the sidewalk. You're walking a very small dog, and I'm not going to try to draw this dog with a mouse on here. It's going to look like a tick or something like that. But here's your dog, and your dog is on a leash. Now, dogs don't necessarily just walk in a straight line like this. Well, some of them do. Mine does not. Mine tends to go all over the place. So while I am walking my dog, I will walk in a straight line like this. He might be all over the place. He might be all over the place sniffing here and there. But ultimately, can you tell that he's ultimately going in the same direction as me? So in this case, larger time frames, like me, establish and dominate the trend. I don't really particularly care where he wants to go and sniff if I have some place to go. I'm going to win that discussion thanks to the leash as well too. Right? So this is a good example of larger time frames establish and dominate the trend. You will find that like a monthly chart will have so much more power to it in terms of the trend than does a daily chart. You'll see a monthly trend going like this, and you'll see the first pullback on the daily chart come along, and people get all excited like, here it is! This is it! This is the one we've been waiting for since 2008. And then what happens is that leash gets taut, and it goes right back up again in the direction of the monthly trend. Larger time frames establish and dominate the trend. Now, I know that some of you know this, but it's amazing to know. It's amazing to see how few people practice this with their trading. The first dip and everybody loses their mind. They lose perspective of what's actually happening in the context of the market. Okay, so that's price action rule number one. That means when the larger parent time frame is in play, you'll see pullbacks in the child time frames, but they're going to be overwhelmed by the larger time frame trend. Now here's a cool one too. Reversals start from the inside out with smaller time frames. Now some of you may not know about this one. All right, so here's your monthly trend going like this. And some people are sitting there watching the monthly trend for it to reverse. It's not going to reverse by itself. It's going to start by a progression. It's going to start by a progression. What's going to happen for this to reverse is the smallest time frame is going to start doing something like this. It's going to start reversing by putting in lower highs and lower lows and lower highs and lower lows. Now, that monthly chart is not even going to, you're not even going to see it move. Not at all when this thing starts to reverse. But that time frame will then propagate to the next time frame in the chain, and that too will start to go like this, make lower highs and lower lows. So maybe this is like an intraday chart, and maybe this is a daily chart. And then you'll see a big bounce from here, and that will just be the weekly chart getting involved in this. So now the weekly chart bouncing back up, there's the bounce back up, and now the weekly chart is getting involved by putting in a lower high and a lower low. So it's amazing to watch a trend progress from the basic genesis of it as smaller time frame, and you can actually see how it builds out. You can understand how it moves. And this is so powerful, guys. Once you understand how to do this, understand how to use multiple time frames, you can actually see the trend reverse and grow from the inside out. It's almost like watering a small plant and watching it grow. You can actually see how it propagates into a larger trend and a larger time frame reversal. So you're no longer staring at the chart saying, well, I don't know what's going on here. No, you understand it from an organic perspective. You understand how that trend has to grow, and yet at the same time, the larger time frame is still in control. It takes a long time before these things reverse. Right? So this is why I'm not staring at today's market going, oh yeah, we're going to be sitting there at S&P 1800 tomorrow. It takes a long time for these things. You know, it's like an aircraft carrier turning around in the Pacific Ocean. Even if you do a Williamson turn on that thing, man overboard, it's going to take the better part of a mile to turn that thing around. Okay, so reversals start from the inside out. I'd love to talk to you guys all night about this, but because I could talk price action forever, but we only have so much time. So let's move on. This means that we'll see this change in polarity show on the smaller, shorter time frame charts first. Now, the energy rules. Markets are fractal in their nature and how they move. What on earth does that mean? We'll get to that in a second. So markets move in a non-ending cycle between range expansion and range contraction. So we talked about this before. Let me go back to the fractal thing. The fractal, what this really means is when you hear the word fractal, notice how one tree is actually a bunch of smaller trees that form together, smaller limbs form together to make the major tree. When you have a big swing in the markets in a larger time frame, if you go to a smaller time frame, what you'll actually see is it's a series of smaller swings that comprises that. And if you go down in time frame, even smaller than that, each one of these is a small little trend like this. So it's like a little, you know, you got these little baby Groot trends that are in here. Okay? And so if you know how this is all being put together, now all of a sudden you can see how all these market moves are sort of put together, and it's fascinating to watch these. Okay, so markets are fractal. Larger swings are made up of a collection of smaller swings. That's what fractal means. Okay, and then we talked about this one before at length. Markets move, range expansion or range contraction. Range contraction. So let's see a couple of examples on how to use this. You guys want to see some trade examples. So Walmart, this is a recent trade. So what do I have here with Walmart? And I'll show you how simple that this can be. Walmart, it's pretty clear that we have a monthly trend to the upside, right? Walmart, that brand new growth stock, right? High-tech growth stock is exploding to the upside. So it's got a strong trend. It's got a strong trend. Now, in today's market, I don't care about this anymore. I don't care about the fact that the monthly chart has got a gas gauge on E. Nor do I care about the weekly chart has got a gas gauge on E as well, too. But what I'm seeing here is I'm seeing a great deal of consolidation on the daily chart. There's a great deal of energy up here. And it's starting to break out above 100. I've got everything that I want to take Walmart long, and this was on January 8th, just a week or so ago. January 8th seems like a long time ago. Okay, so let's see how this one turned out. Well, range contraction led to range expansion. And as you guys know, if you're trading option spreads, we don't have to have, some massive 20, 30-point move in order to make 50%. In this case, I only had to have the price move about maybe 4 points, and that was worth a good 50% on this trade, or close to 50%. Okay, so you guys see what I'm doing here. I'm trading in the direction of the trend, so that's just simple stuff here, just basic stuff. So trading in the direction of the trend on the monthly chart. The weekly chart is all supporting the same trend. And I've got the daily chart consolidating, building up energy, and looking for the breakout from there. Range contraction leads to range expansion. You guys already know this stuff. You guys already know this stuff. But it's nothing to do with overbought and oversold. If it was overbought and oversold, I never would have taken this trade. I never would have seen the opportunity. Those don't work in today's market, guys. Okay, so that was Walmart. Walmart was $26 per contract profit after commissions, 48.2% return on capital. Not a bad little trade. Do a few of those. So let's see a long spread example with KRE. So KRE is a regional bank ETF. And this one was a little bit tricky to take because it's an ETF, so of course there's no options on it, but I entered this not long before JP Morgan's earnings. So I knew that it was going to be affected somewhat by the bank earnings that were starting that week. So here's the entry that I had on January 5th. Okay, what's my trend here? It's moving to the upside. What's my trend here in the weekly chart? It's moving to the upside. What are we doing on the daily chart? It's consolidating. It's showing me a tremendous amount of energy over here, all the way on the right. There we go. The fuel tank is on full, and actually not a bad amount of gas in the weekly tank either. So range contraction, some of you will recognize that as a pennant pattern. It doesn't matter. You don't have to read chart patterns to do this because the fractal energy study will tell you when it's ready to pop. And range contraction like this builds up a lot of pressure, especially as the price gets near the apex of that. So let's see what happens with this guy. So let's erase this, move on to the next slide, and we can see that we popped out of here. Again, with option spreads, we don't need to see a dramatic increase in price to get a nice return from this. So we were in this for less than a week, was it? Was it about a week? Yeah, it was 1 week we were in this. And let's see, what did we do? So I ended up taking kind of a double exit on here. What I did was we were almost at my target, which was 79 cents. So my target was 79 cents on this one, but it was the day before JP Morgan earnings. And so what I decided to do in the late afternoon was to say, well, let's take half the position off. Let's book some profits here, and so we don't we can mitigate some of the risk from the JP Morgan earnings. Well, the earnings came out the next morning, popped, so we took it off first thing, actually over our original target profit. So this turned out with exactly a 50% return on capital. I like those. Keep doing them, right? So they're just nice, simple trades. We don't have to have a huge movement in the price to get a nice return from these trades. And what I also like about these is risk managed. Notice that this is a $1 wide spread. So the most I'm risking on this trade is 50 bucks per contract. That is the most I'm ever going to risk on this. This is a limited risk spread. Lovely. So this analysis allows you to manage risk better by not chasing a chart moving into exhaustion, as well as identifying with a stock that everybody stopped watching. This is the key here. And you guys will start watching for stocks that are coiled like this. You're not going to be chasing after the same junk that everybody else is, which is already into exhaustion. You're going to be looking at the ones that are coiling, and you're going to turn yourself into the smart money. So we can also identify higher probability entry for a credit spread based on an exhaustion. Now this is tough today. This is tough today because the market tends to, we're getting into this runaway condition. So I don't want to make it sound like this is easy, but this is traditionally when we get those exhaustion points, is that I can set up either a calendar spread or some type of iron condor against that on a short-term basis, and it gets stalled out up there. Range expansion moves to range contraction. We use an option spread for that and say thank you very much. So it's a very accurate way of doing it. Right now, again, I caution you against doing this because we're in a runaway condition. This can go in a much more violent way until this is finished. So keep that in mind, is that this is very unusual what we're seeing right now. So since this methodology is based on price action and fractal relationships, it works in any type of market. I use this for stocks. I use this for futures day trading. This will also work when volatility returns. When the volatility comes back, it's just going to be larger time frame volatility. That's the key here, is the larger time frames are going to take over. And so you're going to see the smaller time frames like the daily chart being whipped around, and you're going to say, this is insane, but it's not insane. It's just the larger time frames are in control, and you'll know that. So now let's put it all together. And we're right on time here tonight. Number one, we're going to summarize here. Today's market has been difficult to trade for many reasons. We've gone over this. We've beaten this into the ground, right? Number two, implied volatility is on the floor. Complacency is extremely high. Risk is also extremely high. A lot of these people that have only traded just this bull market over the last couple of years do not know what they're in for. So trade accuracy, risk management is paramount today. Existing methods of analysis don't seem to be adapting well to this environment. When I say existing methods of analysis, overbought, doesn't work, doesn't work. Don't do it. Don't fall for that trap. So we need a method that's going to work today as well as tomorrow when the volatility does return. It will. So we not only want a system that's going to work to identify breakouts, but also one that identifies exhaustion. So I know of some systems that look for the coiling, right? But they don't identify exhaustion. So this study has got both of them in here. This is why it's so useful, so valuable. High probability of contraction of the range. Number six, we also want a system that you can use regardless of the underlying instrument and time frame selected. We want to use something that we can use across the board. We don't want to have to reinvent the wheel every time we want to trade something different. Oh, this is my credit spread analysis strategy. Oh, well, this is my debit spread. Oh, this is my iron condor analysis strategy. No, come on, do one thing and do one thing for everything. This is what you're trying to identify. Range expansion, range contraction. So guys, I've just told you everything you need to know. You've got the charts, you've got the studies. You can go off and start making money with this tomorrow if you want to. You can start applying these concepts of your own, and that's what I encourage you to do, is to understand how to build it on your own. create something that's yours to get better accuracy to your own system. If you're like me, you may want to go a little deeper though, as the edge is in the details that we've learned over the years. So for those of you that want to see the power of this method and you want to save a few thousand hours of your time to know the exact details of the setup, like these, like how to use multiple time frames to increase accuracy, understanding how to evaluate the market energy, whether something's exhausted or it's ready to go, the principles of fractal energy trading, reading price action. Do you understand how to read reversals and what constitutes a reversal at what time frame? The best vertical spread strategies to employ depending on the move. They're different, right? It depends on what's happening with the implied volatility as well too. There's certain advantages that you get by certain combinations of the move and using the right vertical spread for those. So when to use credit spreads versus debit spreads for maximum accuracy, and how to build a whole trading system around this one system. I think this is so cool when you can just do one thing and just use it for different time frames. You don't end up wasting your time learning something you may only use every once in a while. So we have, as you might imagine, the class for this, improving vertical spread probabilities. So Trade Instructor was me, okay? It's available right now, over 3 hours of live content. You guys can have it tonight if you want. Slides, replay video, studies, this is already in the can, how to read price across multiple time frames, creating scans from these conditions to have the system identify targets for you. Wouldn't that be cool? Create scans using multiple time frames. So how do you do an exhaustion within an exhaustion and an exhaustion, right? So scan for stocks that are triple exhaustion. How do you scan for stocks that are in triple consolidation, building up a tremendous amount of power, looking for a massive move? I can show you how to do the scans for those. How do you identify optimum conditions for price movement from consolidation? How do you do that? How do you use this system for short-term intraday trades? Different signals for debit spreads and credit spreads. They are different. Okay, so beyond the class, we've got these bonuses though. You got to hear about this. Is kind of actually crazy that we're doing this, because I started looking at these bonuses today. We're giving away the sync. In addition to the live content, the slides, the thinkorswim study, the scans, the examples, the archive of the session, all of that, plus the ability to watch the archive video as much as you want, you also receive the following bonuses for signing up today. Number one, fractal energy trading. So this is my signature class that I do. This is a 5-part video series. So it took me 5 hours to go through this. You don't have to do it all at once. You can pick it apart. You can take your time to do this. Learn how to read fractal price action, which is the basis for this. Learn how to interpret energy signals on your charts to understand the potential for trend. I believe it is one of the most innovative and accurate technical systems currently on the market. I don't think you're going to find anything else that's going to be this accurate and this versatile. So making price a focus for your analysis instantly puts you a step ahead of the others that are using lagging signals. So normally this would go for $1.50, right? That's bonus number one. Number two is the study itself. So you got the study itself you can use. It's not available with most charting platforms, but is available to TheoTrade customers as part of our service. Normally that would sell for $1.50 as well too. Bonus number three, Options 101, Basics and Beyond. This is a 5-part series taught by Don Kaufman. Goes well beyond what others teach to beginners, and most advanced traders learn things that they never knew from watching Options 101, Basics and Beyond by Don Kaufman. Okay? So again, retail value $1.50. You're starting to get the picture here. These are the bonuses here. Options 201, again, taught by Don Kaufman, vertical and calendar spreads. Learn them the right way. Don't learn them the wrong way like other people are teaching. Retail value $1.50. Bonus number 5, Options 301. It doesn't stop here. Volatility and expected move essentials, taught by Don Kaufman. Learn the secrets of implied volatility and the expected move. This is what the professionals are using. This is how they trade in Chicago, guys. Retail value, $150. And then bonus number 6, one of my pet classes, is the plan or get slaughtered class, which is perfect for January because you all went out there and made New Year's resolutions that you've already broken already. So why do those? Why instead learn how to plan effectively? This is a 3-hour class taught by myself, how to create a trading business plan, how to attain the right mindset for success and turn 2018 into a very, very good year for yourself. Retail value, again, $150. So what is the cost for this program? You guys are saying, what is the cost? What is the cost? Well, if we add up all this stuff here, so the fractal energy, we add up the fractal study, the options 101, options 201, options 301, planner gets slaughtered. If we put all of that together, that's $900 in bonuses, not including the class itself. But for tonight, we will include all these bonuses if you sign up today for the vertical spread class at $97, all of this. So you're going to get enough video and material to probably keep you busy for the rest of the month for this. Imagine how much different your trading is going to be if you sign up for this program, which is at TheoTrade.com/DocSpread. DocSpread, D-O-C spread. Okay, so some of the questions that I get with this is this a trial subscription? I'll get to your questions here in just a second. I will open up the chat room and take your questions live here in just a minute. Is this a trial subscription? Will there be additional billing at some point in the future? No, this is not a trial. This is a one-time thing. Unlimited access to the on-demand recording. One-time $97 fee. We will not hit you again with this. That's it. All that information for $97. I don't have experience with options or futures. Will I be able to follow along in the class? Yes, you will. It's generally for options traders. Again, we're talking about vertical spreads here. So, but if you don't have any experience with that, if you just are a stock trader, it will certainly also help you identify much better entry and exit points. Can I use this with my 401k or IRA? Yes, it works with any chart, any instrument, any time frame, my friends. I work full-time and I can't trade during the day. Can I use this program? Yes. Yes, you can use this to identify when you want to enter, and actually it's sometimes helpful to enter while you're in a consolidation pattern and not try to chase the breakout. The breakout is actually when a lot of people lose edge on the entry. And this is my favorite. I currently use either Elliott Wave and ADX and MACD and Stochastics and Bollingers and CTI and Market Forecast and star.star, whatever it is my current system. Will your system help me? Well, here's what I would say about that. Any system that teaches you price action is going to get you closer to where you want to be because it's going to cut down on your delay. Price action is the only study that's out there that is not trailing. It is real time. If you can learn how to read price, which is very simple, which is one of my specialties to teach people how to learn price, you can improve your trading. That alone, I think, is worth it. So some people say, I don't use thinkorswim. Can a system still help me? What can I do here? There's actually a lot of platforms that are out there that do carry the FE study. It's known as the choppiness index. Ours is slightly different in the way that we implement it, but you can still use that, or you can even get away with using the ADX, but it's not quite as accurate. Okay, so you won't be able to do scans or things like that, but you'll be able to, and you might be able to find somebody to program it in the language that you have. Okay, so here we go, guys. Again, the cost here is for all the bonuses, $900 in bonuses, all of that, and the class itself is only $97, but you got to sign up tonight. And that's TheoTrade.com DocSpread, TheoTrade.com DocSpread. And I have reached the end of my material, and I'd be happy to take questions from you guys starting right now.